So good morning, everyone, and I would like to welcome you all to today's webinar. My name is Ivy Hesse, and I'll be your MC for today's event. Now, before we proceed any further, let's share a short word of prayer. So shall we pray? Dear Father, thank you for the gift of today and the opportunity to convene for this event. We ask that you bless this event and make it successful to the benefit of our industry and to the glory of your name. In Jesus' name we pray. Amen. So welcome again.
Amen.
Activities.
Amen.
Now, I'm sure we've all felt the effects of COVID-19 in one way or the other. A lot of the initial impact has been negative, affecting the jobs of those that we care about, incomes, and the entire economy. And so we know without saying much that the investment industry, and by extension, the pensions industry will also be under stress. But that doesn't mean that we're going to fold up our arms and then just watch, because in the midst of all these uncertainties lies opportunity. And for us in the investment industry, this will be the opportunity to seize and capitalize on those opportunities and generate returns for our investors. And so in this webinar today, we'll be discussing the opportunities that lie in what we are experiencing now to forge a strategy for a resilient pensions industry. And to do that, we'll first have the strategy presentations that will form the basis for the panel discussions that we'll have later on. But before we proceed any further, I'd like to take this opportunity to say a big thank you to Access Pensions Trust for supporting the CFA Society Ghana to host this event. So thank you very much, Access Pensions, for your support. And finally, to a little housekeeping before we move on. I urge you all to keep your microphones on mute. We've had some people giving us some background information before we even started. So please make sure that your microphones are always on mute. It's only the panelists that will have their microphones enabled when they are talking. So please keep your microphones on mute. I urge you to keep to that directive. Secondly, too, I want us to know that there will be no questions during the strategy presentations. We'll save all the questions for the Q&A session after the panel discussions. So if you have any questions as the presentations go on or the discussion starts, please submit your questions using the chat window. If you're using your mobile device, you see a section called chat, or if you're on your PC too, you see the chat window. Please click on that window and type in any questions that you have. We have our technical people in the background who will collate all your questions and pass them on to the moderator during the Q&A session. So that's it for a little housekeeping. Now let's move on to the first order of the day. To do that, I'll now call on Alex Asiedu, CEO of Stanlib Ghana Limited and the President of the CFA Society Ghana, to give us the welcome address. Alex?
Good morning, all.
Good morning.
And welcome to this webinar, Rethinking Pensions Investment Strategy Amidst Uncertainty. These are strange times, eh? Just before you speak, I had to run from one corner of the house to the other because my neighbor was banging his door tonight. There was a lot of loud noise. And that shows you how strange the times are. You know, the times are strange when the same neighbor passes food over your wall to celebrate a birthday instead of coming to sit down with you and enjoy. There's a lot of fear. There has been a lot of fear. There's been a lot of uncertainty. The sad thing is that that uncertainty has fed into the real economy. I mean, for the first time in a long while, for example, our GDP will barely do more than 0.9% in growth this year. And it cuts across. I mean, for countries like Singapore, which I've always held in high esteem, they will they'll cut off more than 30-40% this year. And so these are strange times. Now, you juxtapose that with the growing importance and momentum of the pension sector. Last time I checked, the pension sector now makes up about 65% of the whole investment universe in Ghana. 10 years ago, it was less than 2%. So it's an important sector. So two things. there's a lot of uncertainty, and there's the growing importance of the pension space for us. And that's why we're here. We want to use this webinar to flesh out strategies that will help us help the industry to ride out the uncertainties and the storms that we are facing. That's why we're here today. This webinar is important, both for the recipients of the capital that we deploy, because it goes into the real economy ultimately, and they grow, and also for us, so that our pensions can grow when we get into our retirement. And so hopefully at the end of this 1.5 hour session, we would be able to learn more strategies that will help us to do what we want to do. That's ride out the uncertainties. And we've empaneled the best on the market to do this for us. And so enjoy yourself, sit there, relax, make your notes, and let us learn how we can ride the volatility that we are facing now. Thank you and welcome once again.
Thank you very much, Alex. Now we'll have our very first strategy presentation. And to do that, I have Karl Ocran, investment strategist at Access Pension Trust, to present the economic strategy for us. Karl?
Hi, and good morning, everyone, and welcome to this strategy webinar. So for many of us, the realities of COVID sort of hit home in March, and since then it's been 6 months of pure survival, digging deep and trying to keep the lights on at home and both at work. But the harsh realities are the months ahead even present more uncertainties, especially given the response from both the Bank of Ghana as well as the Finance Ministry in trying to resolve this pandemic. And as fund managers, we have to navigate these uncertainties to ensure that, you know, the owners of the assets that we manage, even amidst this chaos, remain confident that we would assume a position of care and prudence in trying to preserve their wealth as well as grow their wealth. So in the next few slides, I'll walk you through briefly the macroeconomic context in which fund managers are faced as they think about expectation on security returns and asset allocation in their work as to deploy assets. So before COVID, that was at the end of 2019, it was no secret that Ghana's economy was, you know, on the right course. GDP was heading north. Prior, we had grown 7% average prior to 2020. Inflation was well anchored within the medium-term expectation, and expectation of inflation was also heading downwards, and that sort of propelled interest rates to also move down. There's no doubt that Ghana was, you know, amongst probably the most talked about nations globally in 2019, as the administrations of the day did a good job in selling the story of Ghana through programs such as the Year of Return and Beyond the Year of Return. But then came Corona, and we were coronally hit, as we would say. And just to put into perspective how bad the situation is, based on the current forecast from the Ministry of Finance on 2020 growth of 0.9, it's going to be the lowest we have grown since 1983, but for the past 37 years. And that is how bad the situation is. And not just in Ghana, but other economies are also, you know, even recording negative growth. But more importantly, how is the real economy being felt? We tend to be lost in, you know, in the final jargons of GDP, fiscal policy, and interest rates. But what really matters is the real economy. So how are they being felt? A survey by the Statistical Service in partnership with the World Bank did a report, and the results were as follows: that 93% of businesses have reported a decrease in demand and sales. Now, these are micro, small, and medium enterprises that account for over 80% of employment in Ghana, and 1 out of 2 of them are facing difficulties in finding inputs, whilst 3/4 of them are struggling with cash flow. even more dire is the fact that 1 out of every 2 Ghanaians have had to reduce food consumption in order to get by. Very disappointing statistics. Now, if you drive out of your homes or your offices and you look, 1 out of every 2 Ghanaians has had to cut down on food in order to just get by during this period. And our kids, 3 out of 10 of them, more than 3 out of 10 of them, have reportedly missed their vaccination in order to save income to get by, whilst a significant majority of them haven't learned anything in school. These are our kids, the future generation, and this is what is happening to economies, not just in Ghana, but all around us. And the Bank of Ghana, through its reportage, explained to us or highlighted how bad it has been, given that VAT collection has been down dramatically, whilst taxes, if you take in cognizance the previous slide, of businesses struggling, of consumer being absent, not enough revenue being raised by the managers of the economy. And you can see on the bottom corner right, the impact on the economic activity, which has grown negative. All of these are direct consequences that the economy has felt because of this virus. Now, to respond to these uncertain times, there's been unprecedented amount of fiscal and monetary policy stimulus. Now, both the Bank of Ghana and the Ministry of Finance have sort of had a joint response in order to salvage the situation. And a lot of these measures have been talked about. In the interest of time, we'll not go into detail. But it just highlights the points that even globally, both monetary and fiscal solutions have been put together to salvage what is being left of in economies. And as we think about key risks going forward, the consequential impact of these policies, will drive risk as we think about risk in the Ghanaian economy. If you look at our fiscal position, which hitherto was not, really encouraging, and now there's been unprecedented amount of fiscal stimulus as well as monetary stimulus, what does this impact on our fiscal position? Especially absent growth, there's a risk of, our debt to GDP going way out of proportion. And given that in the past, we have focused on financing some of the deficits with external borrowing, taking into account what the city has done, over the years. These are key risks that we're presented with in the short to medium term. And just last week, we had the rating agency come to warn of a positive negative downgrade. So all of these impacts are unknown that could really impact our decision going forward, as and when we think about asset prices and expectation on securities. But not all is lost. There are bright spots in the Ghanaian economy. And day in, day out, our natural resources continue to provide the backbone on which the economy would move forward. Over the past few months, we have seen crude oil prices decline sharply. However, we've seen gold also rise in opposite direction. Now, these two resources sort of provide Ghana with a natural hedge. And so we have not been hit as hard as many of our peers because both of a well-diverse economy, a well-diverse natural resource-based economy. Now, before I end my presentation, let's just pause for a minute and think through certain concepts. Ghana is #1 gold producer in Africa, top 10 globally in the world. We're #2 when it comes to cocoa production. We boast of one of the world's largest bauxite reserves, and we have a very vibrant non-traditional export sector. Let's imagine for a minute what we could achieve collectively as a nation if we develop the value chain along these resources in order to diversify this economy. Most importantly, the Africa Continental Free Trade Agreement presents enormous opportunities for us as a people. But we have the resources, we have the human capital as well. And the question is, would we take advantage of these times? I would end the presentation here in the interest of time. But on this slide, you have various recommendations that could be considered in order to bring back, to borrow the words of our president, to bring back the economy back to life. So Appiah, I will hand over here to you, and then we move forward with the presentation. Thank you.
Indeed, in the midst of the storm, there are still bright spots for us to look towards for the future. Thanks very much, Karl, for the presentation on the economy and the prospects going forward. Our next presentation is by Kwabena Boamah, Chief Investment Officer of Stanlib Ghana, and he will be presenting the strategy for the fixed income market.
Thank you very much, Ivy. So I'll briefly look into the fixed income strategy in the midst of COVID-19. And by way of presentation, I will touch mainly on the three key plans that would help us in the formulation of our fixed income strategy. Now, to do that, I would provide a bit of context, and especially in the light of the topic that we're looking at. If you look at the pensions industry, over 90% of our allocation of all portfolios are into fixed income. This means that over 90% of our income or revenue is actually driven by what we do in the fixed income space. And I think it brings context into the importance of this webinar, and then also looking at your fixed income strategy carefully, because that ultimately will drive your investment objectives. Then also in formulating our fixed income strategy, especially with the tier 2, we are faced with constant cash flow. So it's not about today's gain that you make, but your ability to sustain or continuously enhance your returns over the period. So you can make a good kill today or tomorrow, but then you'll still be saddled with cash flows coming in. And the question is, what do you do with those consistent cash flows coming in? And your ability to formulate that strategy that takes into cognizance these cash flows will ultimately help you enhance the returns of your portfolio. Now, looking at the strategy, and I would look at three key areas. One is credit risk, and then secondly, we'll look at the yield curve positioning, and then lastly, I'll wrap it up with the interest rate outlook and debt profiling. But in order to provide a better flow on the formulation of your strategy, I would start off with the interest rate outlook and then debt profile. Now, interest rates in the fixed income space is the ultimate engine that drives all our cash flows, either today or tomorrow. So your ability to lock in at good rates, and then more importantly, to understand where interest rates are trending, will help you in where you want to play in the fixed income space. And it also informs the type of dealings you would do in the fixed income space, your choice between floating and then fixed rate notes, depending on what your outlook on interest rate is. So I say that we need to understand where we are and what the likely trends will be from now to the next 3 years, the next 5 years, and even the next 10 years. And once you have an understanding of this, you would begin to take positions on the yield curve that will ultimately drive an enhanced and continuous or sustainable returns over the period. Okay, so on the interest rate front, in terms of understanding where interest rates are to determine where you will play in the fixed income space on the yield curve. Now, if you look on the screen, you would realize that all the macroeconomic indicators point to the fact that interest rates should be elevated in the near term. You look at our debt to GDP, you look at our debt service ratio, you look at our deficit, and this, when we had the conversation with the Minister of Finance, if you add the energy sector debt and the financial bailout debt, you're looking at a deficit of 14 plus, and you look at our primary deficit, you would realize that everything points to a rise in interest rates. However, there's greater effort or a hand from the central bank trying as much as possible to suppress this elevation on interest rates. And that will mean that even though interest rates should be rising, probably in the short term, we might not see it happen as it should. And this is all because the central bank is intervening more actively. We've seen that with the policy rate dropped to 40.5 and maintained. We have also seen that our currency has been much more stable now. And I don't think that inflation is actually out of hands. It's pretty much not under control, but still gives us room as far as the real rate of return is concerned. So this activity by the central bank geared towards stimulating economic activity to help bring the economy back on track will definitely continue to play in how we look at interest rates in the near term, 3 years and then beyond. And because of this, I would say in looking at any duration or any tenor in less than 3 or 4 years, probably you'd be safer off looking at a floating rate note. And then anything beyond that, you should be looking at fixed rate notes in your portfolio. And that brings to the next point on the debt profile. This also gives us color in looking at where we want to play in the fixed income space. Now, if you look at the debt profile, you will realize that there has been a shift from the short end into a cumulative short and medium-term focus by the government. And prior to recent times, we've had a lot of allocation or government borrowings in the short-term space. But the debt restructuring has seen debt move from just the short end into more of the medium-term and then also some long-term offers from the government. Now, if you look at the amount of offers in the medium term, this just gives you an idea of the kind of liquidity that is within the medium term bond space on the government side. And for your portfolio, given the kind of clients that you have and given the kind of constraints that you have in your portfolio, this will provide you some form of liquidity. And I expect the spreads in this space to be thinner than the spreads on the longer end of the market. However, the ESLA bond, the 2031s, has been of a surprise because that has also seen a lot of activity, even though it falls into the long end of the market. So in formulating your fixed income strategy, we've seen one key thing, that is your ability to forecast interest rates. And depending on where your interest rate outlook is, it gives you an idea which side of the fixed income portfolio that you want to play, or which side of the yield curve that you want to sit. If interest rates are going up, you are better off sitting on the shorter end of the curve, where you can unwind your position so that you can take advantage of rising interest rates. But if interest rates are likely to decline, then you lock yourself up on the long end of the market so you can continue to enjoy enhanced returns even though interest rates are declining. Now, given the elevation and then the work of BOG, I would say that interest rates are likely to remain probably where they are and then oscillate in a shorter band, both upwards or downwards, given what is happening or what the government is doing at any point in time. So probably remain, but there will still be the pressure of interest rate rising, and therefore important to look more of your medium or short to medium term angle. However, you keep your eye on the long term and lock in some yield pickups from there. Then the second one you need to look at in formulating the fixed income strategy is the yield curve positioning. And this is heavily dependent on your view on interest rates, as I mentioned earlier on. Now, just to give you a bit of color in terms of how important this is. And even before I look at this, fortunately or unfortunately for the Ghanaian market, we do not mark our bonds to market. And this means that our interest rate movements do not impact us as heavily as it should in our portfolio, irrespective of where you sit on the yield curve. And this is because we hold to maturity or we rarely trade securities. But if we're marking our bonds to market, we would pay a very good close eye to where we sit on the yield curve, because every interest rate movement will have an immediate impact on our portfolio revaluation. Now, if you look at the Eurobond rates that we have, there's the government of Ghana Eurobonds that have been issued over the period. Now, forgive me for my sense of color, but this one looks like a brown or a wine mixed together. And this is what happened immediately when COVID kicked in March for us. Now, the greenish line is where we were at the beginning of the year. We saw an elevation, a drop in prices, leading to an elevation of yields on the Eurobonds. And then this has normalized as we speak in August, and still reversing back to where it was before. But on the cedi, typically what happens in our industry is that in election years, we rather have interest rates actually going up. So unlike what happened on the Eurobond space, we expected interest rates to be going up in the beginning of the year, and then probably towards the end of the year remain stable, and then in the next year after elections, we see a recovery. But this is where we were before that early January, almost like nothing had happened even when the COVID set in. But then with COVID, we saw the policy rate decline, and we saw an immediate shift of the short end of the market decline. But then the long end of the market, or medium to long end of the market, was sticky and did not decline nor even move up. We saw some blips of upward movements on the medium to long term side, but not significant and obvious as we see in the Eurobond space. And kindly, if you look at where we sit, there's quite a lot of yield curve, yield pickup from the 2, 3, and then 5-year band. Now, the yields on the longer dated instrument, if you take out the ESLA 2031s, the rest have a lower yield on that side. So in terms of strategy, you would want to be looking at this band where you're likely to get some yield pickup, and then also take some specific picks depending on what is happening and the flows or demand and supply on the longer end of the market to lock in some good yields in that side of the yield curve. But I would believe that the middle band provides you some opportunity to enhance your returns in your portfolio. Then lastly, credit risk. Now, so we focus heavily on govies when it comes to the fixed income space, because that's where we have a lot of assets to play with, and we also have liquidity. When it comes to the corporate bond issuance or anything outside of government, they are readily not available or they are readily not tradable. Most of us try to get hold of it, and once we get hold of it, we would rather keep than trade it, because we still have cash flows coming in that we need to invest. So on the credit side, even though we focus heavily on govies, we still should have an eye on corporate issuance and probably private debt, especially with the new investment guidelines coming into place. And I believe that there are some opportunities even in the corporate side once they are available on the market. And with COVID, we would want to look at which sectors that we want to play in. And on this score, return rates dynamics obviously is the order of the day. So you need to know the kind of risk you are going into, and then also the kind of risk premium or returns you want to glean out of that investment in the corporate space. But we will think that if you're looking at investments in the ICT logistics sector, you should be sitting pretty good in terms of your credit risk, given what's happening with COVID-19. If you move along the medium rates, you're looking at manufacturing, real estate, and then the financial services. And the financial services mainly on the back of NPLs, given what's happening with COVID-19. But manufacturing, depending on which players in the industry you're looking at, you probably should have probably a low to medium risk, given what is happening now because of the local demand for the things that we need internally with restrictions on border movement. Then, well, the high risk areas, hospitality, given what's happening. But if you put all this together, we know that these interventions are for the next 2 to 3 years, and we expect economies probably to recover. And because of that, we would want to pick this in together with the kind of tenors you are looking at. If you're looking at tenors, then it should inform your risks in terms of what tenor you will put on that particular sector paper that you're looking at to invest in. So we've looked at 3 key areas in formulating our investment strategy in the fixed income space. One is your ability to forecast interest rates. Once you have a good handle on where interest rates sit, then it will inform you on where on the yield curve that you should be playing. And we think interest rates will probably be oscillating around the current levels, for which reason a mix of your medium with specific picks in the long term will add value to your portfolio. Then again, if you look at your credit risk exposure, it will also give you an added value by picking and choosing which sector you want to play in on the corporate end of the market, and also building in the correct risk premium and monitoring the cash flows. But all put together, the question is, who knows tomorrow? And we are in a new normal. So we trust that our judgment will carry us in making the right decisions. Thank you. Back to you, Ivy.
Thank you very much, Kwabena. Who knows tomorrow indeed. Now we have our final presentation about the strategy for the equity market. And to do that, we have Derrick Mensah, Head of Business Development for IC Asset Managers. Derrick, are you with us? Yes, over to you.
Hi, Ivy. Thank you. I think for the purposes of this discussion at IC, I kind of wear 2 hats. So just to give the audience a bit more context, I also am portfolio manager for equities at IC. So I have a bit of knowledge of what we are about to discuss. With that, I'll share my screen and we can commence the discussion. So the presentation will broadly touch on about 4 different areas. One, giving a bit of background or a bit of context as to what's happened on the market over the last few years. I know the equity market has been on a bit of a slippery slope since somewhere 2017. So we give a bit of background on what's happened and why it's happened. And then afterwards, we sink into what our expectation is for the rest of the year, perhaps into Q1 next year. And we then discuss portfolio strategy. What do you buy? What do you consider in terms of equities, and how do you put together your equity portfolio, especially during COVID uncertainties. So moving on to this slide. This slide is basically giving you how the Ghana Stock Exchange Composite Index, which is the index that measures the performance of all the stocks on the market over the last three or so years. The reason I've gone this far back is just to build a bit more context. Now, the equity markets closed, I think it's been downhill since middle of March 2018. And this is largely as a result of how a combination of the financial sector crisis, or the reforms that have gone on in the financial sector from 2017, and the green circle you see over there highlights the downhill from COVID-19. Now, the reason why we've had a bit of a downhill with the red sector, where the red dotted line is largely because of the financial sector crisis. One, there was a lot of uncertainty coming in from what the capital requirement looked like. So you had a lot of traders on the market not certain if some banks will be able to raise the capital, and if they're even able to raise the capital, how will it dilute their return on equity? So valuations were a bit jaded over that period. And as a result, investors shy away from uncertainty. So you had that period. Then you had all these financial sector issues, revocation of licenses, banks. There were a lot of uncertainty within that period. So especially coming on the back of a 52 or 53% return in the previous year, it only made sense for investors to take profit and to shy away. Then we have that green slot where we've seen further decline, and that has been as a result of COVID. You realize that somewhere around February or early January of this year, there was a bit of uplift on the market where we felt that things are going to turn positive. Then we had lockdown measures, and we've been seeing the impact since then, and that has been the result of that downward slide. So this is just to give you context on how the equity market has performed over the last few years. Now, to what do we expect the equity markets to do over the rest of the year and into Q1 2021? Well, it's a mixed bag. My mentors will tell you that, a few of my mentors will tell you that whenever you see any downside or whenever you see uncertainty or volatility, there's a lot of money to be made. And that's how I like to look at the equity markets. There's a lot of uncertainty since February all the way through to the rest of the year and potentially even into Q1. We have a few things working against us on the equity market. One is that corporate earnings, which is the profit and loss statements of listed companies, we don't expect very good returns, to say the least. You will see the graph on the right-hand side, the bottom right graph, indicates that, shows how year-on-year, half-year results of corporate reporting has been. In the banking sector, on an average, profit have grown. We've seen profitability, but on a year-on-year growth rate, we are seeing somewhere around 25% compared to 34%, and in some cases, even 50% in the previous year, over the same period in the previous year. The consumer sector, which is where you find the likes of Fun Milk, Unilever, and Co., have been the hardest hit. And you can see that with that about almost 160% decline in profitability. In fact, consumer companies are making losses, and largely on the back of the impact of COVID-19. We will explain that later. I think the only sectors that are really doing well will be the telcos. And when I talk telcos, the only telco on the market will be MTN. And we have seen some strong growth coming through from the insurance sector as well. So this is just to tell you that we expect earnings, which is the profitability of companies, to be a bit slow over the next few quarters. And as a result, prices are driven by such strong results. And if you are not going to see strong results, it then doesn't justify valuations, and it doesn't give the sentiments, doesn't force the sentiments to see price appreciation. So that's one. The second thing is that we are in an election year, and we are close to elections. So what you tend to see there is that investors, and mainly foreign investors, who account for about 60 to 70% of activities on our market, shy away from our market during election years. And so you'll see that the bottom left graph gives you an idea of portfolio inflow since the start of the year. In fact, it gives you all the way over the last 12 months. And you see that you have been seeing negative portfolio inflow from foreigners, which simply means that foreign investors on our stock market have been selling. And the biggest sell came in June. We expect that while we don't expect significant numbers like what we saw in June, we still expect negative portfolio inflow, which means there will be an outflow, especially from foreign investors, all the way through to the end of the year, largely because of elections, and also because of uncertainty. Typically, during that period, just after elections, when things are calmer, things are settled, you are sure which government is running stuff, you then tend to have investors flow back into the market. But then we are hit with another issue, which is currency. Foreign investors, again, who account for about 60 to 70% of our activities on our stock market, are looking to the cedi and the performance of the cedi. Not just for this year. This year has largely been stable. We don't expect any volatility, significant volatility. But we are looking at next year, which comes to the big graph at the top. The big problem that we see with our currency is really on the back of how we are managing the fiscal situation in Ghana. June 2020 numbers show that we are running a significant deficit. So revenue shortfalls, we are doing about 5.7% of GDP when it comes to revenue, which simply means we are attracting less revenue than we did same time last year. And we are spending much more, double or almost double what we expensed last year. Simply put, we are widening our deficit. And this has a strong correlation between how our currency performs. So whilst we have strong gross international reserves, we have things that are mitigating the impact of currency depreciation this year, when it gets to next year, with the level of debt we've accumulated, our repayment capacity, the fact that we may not, Eurobonds or international markets may not be as favorable as they were at the start of this year, we think that the currency could potentially come under some form of pressure in Q1 next year. So whilst we are expecting some form of bearish market, and traditionally you expect foreign investors to jump back into the market post-election, you then have what we call the triple whammy effect, where you then have a currency issue, which is likely to keep the foreign investors away for a while until they have some comfort in how your currency performs. So all in all, we expect that market is likely to remain bearish. But as I said at the start of this slide, a lot of my mentors will tell you that when things go aerial, when there's a lot of volatility, there's a lot of uncertainty, that's when to make a lot of money. So that takes me to my next slide, the opportunities. Now, whenever you have such a market, you will realize that stocks on the markets that were pricey or very expensive back then, all of a sudden have become cheap. And again, you have to look, cheap is relative. So you have to look at it in terms of value or the valuation of that stock. The fact that something was 10 cedis last year and today is 5 cedis doesn't mean it's cheap. It could be that at 5 cedis, the profitability of that company has dropped from 1,000 to loss making. So at that point, it's not cheap. But interesting enough, you realize that a lot of the top companies listed on the market that were trading at very high multiples or were relatively expensive have all of a sudden become cheap. So what I tell my equity investors is, this is the time to bring out your wallets. This is the time you need to go shopping and be patient enough and watch the market return. We've seen this, well, not this level of crisis, because we haven't had the pandemic hit Ghana this hard before, at least not in my lifetime. But we have seen the market go through several cycles where we've gone through a protracted period of downturn, and we've seen the market bounce back. And most often, especially for local investors, we catch in the stock market when it's on a rally, when things are going up, and rather when the foreigners are jumping out, that's when we are coming in. So that has been the problem, and that's why a lot of local investors do not have a lot of, they are generally averse to stock market investing. The important fact was picking your stocks and buying your stocks is timing. And I feel that this is the COVID-19 has presented a good buying opportunities, not for all the stocks, but for some particular stocks. So focusing back on the slide, the dotted line where you see a lot of dots all over the place is just a graph that is just giving you an idea of how valuations are looking relative to returns. So on the left side, you see the gray graph, the gray dots are showing you where valuations are as at half year 2020, and blue dot shows you where valuations are as at half year 2019. So I'll just pick two stocks. For instance, you're looking at Standard Chartered Bank, which is at the top. The blue one is at the top. And at that time, 2019, this year, it was trading at 2.5 times book values. That means that the value on the book, on the market, it was trading 2.5 times that. Now, we look at the gray graph for Standard Chartered, and it's dropped to about 1.7 times book. And not only has it dropped in terms of value, it has also extended the type of return. In 2019, it was returning about 20% on equity, which means if you put your equity in, if you put in, let's say, a CD, you were going to get about 20 pesos return. But that was at 2.5 times the price. Now, it is even returning close to 30%, which means if you put in one CD, you are likely to get about 30 pesos. And not only that, it's now trading around 1.7 times book, which is cheaper and returning more. So there are a number of these stocks on the market that have become cheaper. And therefore, even though there's a lot of uncertainty, there's a lot of aversion, risk aversion, there are a lot of opportunities as well. So you need to be focused on these numbers and distill the noise or demystify everything and focus on how are you going to create wealth within this uncertain period. Now, focusing on the graph on the right-hand side, there's a distinction between why we've separated financial stocks from non-financial stocks. It's not right, I'm getting a bit technical now, but it's not right to value financial stocks using what we call the price to earnings ratio. And that's a discussion for a separate forum. But on the non-financial stocks, we focus on the price to earning ratio, and you realize the same effect. Stocks like Bob is now trading somewhere about 6.5 times its earnings. And previously, same time last year, it was about 13 times that. Fund Milk is at a significant discount, but again, it's as a result of something. As I alluded to earlier, they have been loss-making over the last period, so it might not be a good investment at this time. But not to go into the stocks in particular, but generally what we are trying to say is that there are stocks on the market that are returning greater value at a cheaper price. And so this volatility, this uncertainty presents a buying opportunity. Now, to end my presentation, I would like us to focus on 4 key things that we have to do during this uncertain period. Number 1, you need to recognize and acknowledge the risk. My boss will tell you that recognition and acknowledgement are 2 separate things. You can recognize and not acknowledge it, but in this case, you need to recognize the risk which is what we have talked about, that the market is going to be volatile for at least up to Q1 next year. So you need to recognize it. Then you also need to acknowledge that, yes, it will happen. And then you have to determine how you are going to position. Do I get completely out of the market? Or do I know how to hedge, how to pick my stocks, and how do I make a lot of money during this uncertainty? Now that moves us to number 2, which basically says that you need to identify the opportunities, which we spent time on the previous slide indicating. The first thing you have to do is you have to focus on picking the right stocks. Your focus should be on value. As I said before, stocks may be cheap, but cheap is relative. So if it's not focused, if it's not value focused, you might end up buying stocks that were 5 CD or maybe 20% discounted today, but on a value basis, it's still expensive. So you need to focus on the valuation of that stock in you identifying those opportunities. The other thing is you need to focus on the business model of these companies. So when I mean business model, we are in a very peculiar situation with COVID-19. Some consumer companies are telling you that the best part of their year was spent during lockdown, which means people are not going to buy stuff anymore. So revenue is likely to be halved or even more, 75% is going to be eroded. In that case, it's not going to be a good year, or even next year is not going to be a good year for them. You need to focus on business models that have some form of insulation to the pandemic. What I mean is, in this period, what is happening, we are buying more data. We are spending much more on data. We are making calls, we are doing things virtually. So companies with that kind of focus, companies that have migrated to becoming more remote, are likely to have some form of insulation against the pandemic. So those will be things that you look at. The other thing is, you can't go away without talking about banks on the stock market, because they are the dominant players. There are banks there which are looking cheap, but you have to look at their business model. You have to see how their loan book is structured. There are certain banks that have significant exposure to sectors that are vulnerable. So you have sectors such as education, which, whilst is good for the economy, at this point, it's quite vulnerable. And you're going to find a lot of schools and people in academia and so on having their loans impaired. So you are likely to see banks with that kind of exposure have very bad earnings. So whilst you look at the sector at banks, you need to peel off the numbers and see how their loan book is and how they have allocated their loan book. And I have done that exercise, and I can tell you that there are some banks in there, quite a number of them, that the loan book is structured in such a way that they will be able to weather the storm. So you need to identify those opportunities and invest. The third thing is that you need to allocate and hedge your downside. What I mean there is, a lot of investors or a lot of investment houses will tell you, diversify. So maybe you would have picked Stanchart, you would have bought EcoBank, then maybe you think I have enough in banks. Let me go ahead and buy Farm Milk, let me buy Guinness, let me go and buy Starwin, so you are trying to spread out your investments across different sectors, which theoretically, it makes sense. You are not going to be hit by the same factors at the same time. But we did some exercise in my firm and realized that in a market that is as illiquid as Ghana, it makes better sense for you to consolidate your position in some key stocks and have a more concentrated position than to broadly allocate. At the end of the day, you are getting better returns and even lesser risk when you consolidate or concentrate your position in Ghana than when you do so across different funds. So you need to look at that form of allocation. Just don't diversify for diversification's sake. What you also need to do is focus on conviction. If I think that I'm picking the best stocks in the key sectors that are insulated from the pandemic, go out there and pick those stocks and make a profound statement. Concentrate your position in those ones. But as you concentrate your position, you also need to hedge your downside, because I can buy maybe EcoBank and go heavy on EcoBank. Maybe just pick 2 stocks and say I'm going heavy on those 2. Yes, that's what I'm advising at this point, but you also need to be smart and know that things can go against you. Even when the numbers look well, it's a market. People, it's an irrational market, if you ask me. So people are going to think irrationally and sometimes illogically. So you need to know how to hedge your downside. And by hedging, that's when my friend Mr. Boamah indicated that, talked a lot about fixed income. You need to allocate some portion also to fixed income in order to hedge your downside, especially during this uncertain time. And above all, the last thing I'd like to leave you with is that you have to learn to be patient. If you are going to invest in stocks, you need to learn to be patient. I often tell investors this story. Somewhere when GCB was having their issue with the Tema oil refinery, the stock fell all the way to about 72 pesos. At that time, when I was telling investors to buy GCB, they were selling it. In that same year, that stock rallied all the way to about 470 pesos. That same year, less than 12 months. And it's all because the investors saw the reality, they saw the numbers, saw the fundamentals, but they weren't patient enough for the market to react with the fundamentals. So as a result, most of the investors I advised ended up losing out, all because they weren't patient. So one key criteria if you're coming into the stock market, particularly for an illiquid market like Ghana, you need to learn to be patient. So with that, I'd like to focus on the saying at the top from one of my favorite investors of all time, Warren Buffett, which says that look at market fluctuations as your friend rather than your enemy. Profit from folly rather than participate in it. With that, I'll bring my presentation to an end and hand over to you, Ivy. Thank you.
Thank you very much, Derrick. So identify opportunities, hedge your downside, be patient, recognize and acknowledge risk. There's a difference. So that sums up the presentation section nicely. So thank you very much, Derrick, Kwabena, and Karl for setting up the table for the panel discussions. I now call on Eric Appiah, CEO of Blackstar Advisors, to take over as a moderator for the panel discussions. Eric, the floor is yours.
Thank you very much, Ivy, and thank you very much, everybody. Look, it's been a fascinating conversation for me. It's been full of nuggets all over the place, and I hope the rest of the participants have enjoyed it as well. I had a few questions of note, and again, what we said in the beginning was that we would take questions sort of at the end. But what I wanted to do was to, based on each presentation, sort of just ask a few more questions with regards to those particular presentations. And then given the larger numbers of people, and I think I've seen some of the questions that have come up, and I want to give more time to the participants to sort of ask their question and get answers. But Deborah, you're on. Alex had mentioned the uncertain times in which we're in. But one thing I find fascinating in our industry, given the turmoil that we've been in over, let's say, the last year and a half, 2 years, how are you coping generally with the uncertainty operationally as a fund manager in your firm?
Thank you, Eric, and good morning to everyone. Yeah, so like Alex mentioned, COVID has taken everyone by surprise, and it's not just in Ghana, but of course it's a global pandemic. And businesses like ours, which is an investment bank, might think that the light is not so much as on us as it is on the health sector, but you also see a lot of volatility that has a lot of impacts on our type of business. In our type of business, what we've done and the risk that operationally we are likely to face are likely to be in 3 areas, which has to do with business continuity, employee safety, and clients' confidentiality. How are we navigating in these times? For business continuity, how are our companies positioned? Are we in a position to work remotely? Do we have the technology to support it? Do we have the payment channels, digital payment channels to support that. And in terms of employee safety, how are we navigating? For instance, in Databank, what we do in terms of employee safety. So for this year in particular, with the exception of somewhere in May where we worked for very few days physically, we've been doing a lot of remote working virtually from home, but we try as much as possible to ensure that client satisfaction is key. And one more thing for our type of business is how we assure our clients. So we owe it a duty to make sure that our clients are comfortable, they know that their monies are in safe hands. And so what we do is to engage more with them virtually. For us, for instance, our CEO usually has time with investors. We do weekly video updates where the CEO answers questions from clients just to allay their fears in times like this. And in terms of client confidentiality, you cannot agree more with me that working remotely increases the potential for security protocols to be weakened and the risk of cyber attacks to surge. You can also imagine the risk, just a single successful phishing attack could cause on clients' data and therefore its reputational effects on our companies. We try, I think team tries to work around the clock to continue that, to continue reminding staff of the need to carefully check emails before responding to them. And these are some of the measures that we and my company have tried to put in place to ensure that investors are comfortable and business continue to be as usual, with staff morale being increased some way, somehow.
No, thanks for that. And Nana Boamah, on your side, on the trustee side, how do you think fund managers have overall reacted? And that's not just fund managers, the custodians as well have reacted to the COVID environment. And from your perspective, given that you have an eagle's eye view over the industry, how has that sort of played out on your side in terms of the challenges that you guys have had to address?
All right, thanks, Derrick, and thanks the participants. So basically, I think it's been basically the same trajectory as Debbie explained. So we have been on a digitization drive way before COVID it hit. So transitioning from working from home has been quite smooth and easy. In terms of managing our stakeholders, we have been blessed to have had fund managers who are also
like to join this.
Yeah, we have been blessed to have some fund managers who are also technically savvy. So interaction has actually increased during this period. For the first time in our firm's history, we had an internal investment strategy meeting that brought some external fund managers to the discussion. So we've been pretty much good at our end, because our service providers were well prepared before this pandemic actually hit. What we really miss is the face-to-face transaction, and personally I can't wait for things to resume to normal, so at least we can have that interaction, because it is also necessary.
No, that's great. And look, it's good to hear that that in terms of the overall landscape, and that's what I'm pretty much excited about this meeting, because I think we have some of the best fund managers in the industry on this call. And I think the presentations and the way they've been delivered speaks to the fact that everybody is serious about what they're doing and looking forward to the betterment of the industry overall. So I'll just shift over to Karl. Karl, a great presentation on the economy overall. The key questions I had for you there were in terms of, you were talking about local businesses struggling, etc. Is that mainly because of the fact that they can't import goods into the country? And doesn't that actually generate some potential opportunities for local supply chains? Because we've seen local supply chains sort of say, hey, we're getting a lot of local demand and we're looking for funding to be able to meet that demand. How do you see that having an impact longer term? Do we sort of decide that we're going to depend more on local chains than foreign chains, in which case some of the concerns we have about businesses being in continual decline may not then rear its head?
Thank you, Eric. So absolutely. Well, the structure of the Ghanaian economy predominantly is, in the informal sector. And that is a sector that has been, hit hard. And the nature of this pandemic has also been such that, it's been beyond just liquidity. So it's not just companies, having lack of capital to expand or to put into your business. But it's also been on the consumer side where there's been lack of demand because consumers have had to sort of defer a lot of expenditure because they're basically trying to survive. And so that's why it makes this this pandemic one of a kind. And globally, governments are struggling to figure out the best way forward and have to pump massive amounts of money in order to prop up their economies. And so on the outside, looking forward, thinking about solutions, essentially it's, trying to create an avenue where small businesses have access to alternative capital. If you look at the survey that the World Bank did, number one on the response list from businesses was access to credit in order to survive. And so, policyholders must come together and, sort of try and facilitate, for example, private equity vehicles, venture capital vehicles that are out there to sort of provide alternative sources of growth and risk capital to enable these businesses to survive. And also, government can play the role of providing the missing demand until, people can stand on your feet and provide the stock or the demand that businesses need to survive.
Hi, sorry, I'm back. So I missed the last part of your answer. I just have a terrible connection there. But thanks. I'll just follow on with sort of the next question. You did highlight, sorry. So you did highlight also the large amount of stimulus that has been effectively done by the government. Are you concerned about any inflationary pressures? And I think KB mentioned, his view was that rates should widen. And I suspect that may be due to, some inflationary effects. So how real is that, do you think, in the short to medium term?
Well, if you put it in context of where we think output, would react to these measures that have been put in place, I guess the answer is only time will tell, and that means that if we're able to channel these resources into enhancing the productive capacity of the nation, then the risk is more muted. But on the other hand, if stimulus has been embarked on the sake of stimulus and hasn't been targeted well enough, then indeed there's a risk of expectation of inflation, because inflation is just an expectation of where you believe prices would go, and then therein lies the problem. I totally support the dual mandate of the central bank as well as the ministry in trying to provide this help, but it has to be targeted to key sectors. It has to be targeted to enhance production, and that is the only way we get out of this. Less, all of these potential risks that could unfold, like inflation.
Okay, no, thanks for that. Thank you very much. KB, how are you? Great presentation on the fixed income space. It's a space that I've spent too many sleepless nights looking at, trying to, and Karl laid out a great macroeconomic sort of outlook, but sometimes that outlook really doesn't marry with what happens on the market. So just as you rightly pointed out, at a time when we had COVID and was expecting yields to blow out, which they did, but then in the shortest possible time, they come back in very quickly. And now we're seeing a bit of softening overall. But from your view about you sort of picking where to be in the yield curve, and I'll probably just stay a bit more thematic because I see that people have asked some quite specific questions about that. But just to get a sense from you in terms of portfolio management under the fixed income space, doesn't that mean that we should just then move away from, let's say, picking particular bonds we want to buy? As you said, you might get, a good bond for one very short period. Shouldn't we just focus on like an immunization strategy where all we are doing is effectively matching the duration of the assets with matching the duration of the liabilities and managing it that way?
Yes, you're right, Eric. And I think in all that I said, we'll have to put it in the context of the portfolio constraints that you are managing in terms of which tier of the schemes that you're managing. If you're managing a tier 2 and then you're managing a tier 3, your strategy on the fixed income space will not be the same. Tier 2 will typically have a longer duration, and in terms of matching your assets and liabilities, you should have a bigger eye on the long term. Else, if things turn around and you're overly exposed on the short term, you'll begin to see that your portfolio returns will also start to decline when interest rates or the economy is back on track and we see interest rates now coming to a reasonable level. So because of the central bank intervention and the willingness to continue, I would think that interest rates will still probably be around the kind of levels we have seen along the yield curve, with some few probably bips upwards, but not a drastic shift on the yield curve. And because of the level of activity in the medium term, I would believe that there will be some yield pickups in the medium term if you're looking at picking bonds to manage. But then, given what we have seen on ESLA, the 2031s, those who watched that bond carefully will probably have locked in some good yields from March till now, because their quest for cash flow from the BDCs, they dropped the prices which gave you a better yield, and therefore those ones come to add onto your portfolio and then position you against the longer periods when things normalize and interest rates come back to reasonable levels. So I will still bet my penny on playing in the short to medium term, focusing probably more on the 2 to 5 year band, and then doing selective pickup of some bonds beyond the 5 year.
Thanks for that. And at the beginning, you had mentioned, and clearly this is a problem that most fund managers are not shy of, having too much money. You mentioned that there's a lot of cash. But does that mean that we don't have the right products in the market for people to deploy the cash into the products? I mean, we've had a corporate bond market that has been around for a few years. We saw it grow into, I think, maybe 7 or 8 names. We have had some difficulties on some of the names, but some of the others are performing better. What do you think, from your point of view, would allow you to be more comfortable doing more corporate bonds in the space?
Eric, that has been one of our biggest challenge. I mean, if you're an active portfolio manager and you want to do something different from what the market is doing, and then also hedge your portfolio for enhanced returns, the pipeline of assets are really scanty and not available, and that provides a challenge. And I think that accounts for more of the buy and hold positions of most fund managers, because like you rightly said, look, Quantum came to the market, it was buy and hold. Nobody's trading because there are no, where are you going to park the cash if you sell off and make your capital gains? Then apart from the few financial services industry bonds that have been listed, we haven't seen much of corporate bond issuances on the market. And beyond the pipeline I think that the general industry also haven't yet waking up to the risk of going longer durations. So we're more comfortable with probably a high of 5. Rarely do we see trustees give us options to play beyond the 5. So that quest probably is not allowing also room for corporate issuances that have a longer duration than the successful 3 to 5 year issuances that we have seen on the market. So it's a big of challenge. We do not have the asset pipelines to be able to allow you to well diversify and as well as do other things apart from government. We have a huge proportion of our portfolios in government, not because that's what we like, but that is what is available and we can grab.
Sure. Now, and so thanks for that. I just have a couple more questions. So in terms of the lack of products, and that's one thing, I guess that will be addressed with time as the market gets more sophisticated. But in terms of the corporate bond space, will things like credit default swaps or total return swaps or CDOs, are any of those structures or things of interest to fund managers overall?
Well, in the midst of scarcity, I would believe that every portfolio manager will be open to anything that comes onto the market. So that's what we have operated with. Whatever comes to the market, we will look at it. But then we would definitely make the decision based on the risk and return dynamics. Whether the risk sits comfortably with the kind of portfolios that we're managing, and then also the risk makes sense ultimately to the trustees we are going to seek approval for. And Eric, that's the kind of industry we're operating in the pensions space. So trying to tell my corporate trustee that I have a credit swap, even the credit is another issue, let alone swaps. I'm not sure how they are going to handle this approval. So there's a bit of a learning with the corporate trustees. I think it's much easier. But then with the ESS, we still have, I think, some learning curve to cover so that we can open up for such exciting products that will ultimately enhance the portfolios.
Sure, great. And so I'm not going to let this slide, but Nana Boamah, you have to come in and let us know whether you are excited about some credit default swaps, some total return swaps, some CDOs, CMOs, CLOs, all of that. Is it something, how are you guys looking at that? Because, you know, we are in the industry now, but we know what kind of products are.
So I mean, Eric, I mean, that's interesting. So I would say, I mean, we are one of the few, I mean, fund managers, I mean, or the trustees to venture, I mean, first in private equity. So we are, I mean, pretty much open. Anything that would enhance the risk-adjusted returns, I mean, for our beneficiaries, I mean, we are fine. But like KB, I mean, already mentioned, it should sit within the overall, you know, investment policy and portfolio of whatever asset, I mean, we are managing. A CDO, a CLO, I mean, would be a wonderful addition, I mean, to our portfolio in terms of, you know, risk adjustment. It would provide diversification opportunities. I mean, something we are open to. I think Karl, I mean, mentioned, or KB mentioned a point. Over here, we don't really mark to market our fixed income or government bond portfolio. But then if we were marking to market, then trustees and players would realize government bonds, I mean, are not, I mean, so risk-free as we think. So for us, anything that would, I mean, come on board, I mean, to provide diversification opportunity, provide and enhance, I mean, risk adjustment returns, I mean, we are pretty much, I mean, open once it's set within the regulatory, I mean, framework, and our trustees, I mean, are fine with it. But then I would say, I mean, Access is one of the most adventurous, I mean, trustees, I mean, out there. We seek the interest, I mean, of our clients. We are mindful of our economic, I mean, dynamics. I mean, anything, I mean, can happen, and then depreciation, I mean, would be over the roof. And all the values we've built, I mean, over the years, eroded. So we continue to seek out opportunities to protect the real, I mean, value of our beneficiaries.
Sure.
Thank you.
No, thanks. And sorry, KB, as I promised, I was going to come back to you. So KB, I think one of the things that we've seen over the last few years is the the opening up of the pension fund investment sort of guidelines. I understand there's some new draft guidelines, and what I was hoping to do was to get from you a sense of what differs in the old guidelines versus what is in the new guidelines, and what we can look forward to over the next few years with regards to the new guidelines.
So, Eric, on that front, I think what has changed significantly is the alternative space in the new guidelines. That asset class has been expanded, and then also there's much more flexibility in that asset class. And I think that's quite exciting. Then also you would notice that in the new or proposed guidelines, the view on credit rating has also changed. Every corporate debt or every debt issuance must be credit rated. But then I guess the authority will allow for a transition till we have SEC license some credit bureaus or register some credit bureaus in the industry. So these are the two major shifts in the investment guidelines between the old and the new. But overall, in terms of portfolio management, there has been a significant change in the proposed guidelines, where you have constituent funds now coming into play. So trustees will have the burden of establishing constituent funds based on a risk profiling of the underlying members. Now, once this is done, I think it would go a long way in addressing the challenges with the kind of securities that we select for our portfolios. There's always been a hit back with alternatives, mainly because you have younger ones in the 30s, and then people who are in their 50s, 55, have 5 years to retirement. And then you position investment into alternatives. By the time they exit, they wouldn't have benefit. They probably would have been paying or experiencing losses on that exposure, but then they wouldn't benefit when they've left the scheme. But once you have the constituent funds established, what it means that we can then align our risk to the portfolio and then select securities also aligned to that that particular constituent funds. And I think it will also open up the industry for more pipelines that we don't see. So I'm expecting that with the new guidelines and the structure or the restructuring of our pension schemes, we will begin to see pipelines in the alternative space and also some pipelines in the corporate space, because then private debt is also allowed under the particular guidelines.
Now, KB, thanks for that. Derrick, on the equities markets, great presentation again. I haven't sat down and looked at the equity market and to be honest for a while. And actually, I think you made a very good case for why we shouldn't even be investing in the Ghanaian markets. And not to be controversial, when I looked at your charts over the last 5 years, the market has been in constant decline. And I think that's rightly so. You point out, the financial companies make a large part of that. And over the last 4 or 5 years, they've been going through some pretty difficult times. So I understand that. But when I look at the performance of the Ghana Stock Exchange over the last 5 years, and I compare it to the S&P over the last 5 years, which is the Standard & Poor's 500 that's traded in the US, I mean, that's done 70% return in dollar terms. And yet we are, as fund managers managing what we can, we're only limited to maybe mid-30 stocks in the 30s, of which none of them are really global companies. None of them really have been driven greatly by any new innovation. I find it difficult to differentiate between the banks that are listed. It's really a touch and feel case. So from your point of view, do you think that we should, not that you shouldn't have Ghanaian equities as a position, but should we focus less on that and finding ways to deploy money in other markets and not necessarily the US?
Well, it's always a welcoming idea to actually look at other markets. It goes to strengthening the portfolio in terms of looking at it from a geographical point of view. However, I think that the bigger problem that we have in Ghana, especially when it comes to equities, is the lack of expertise for equities in general. So while you talk to some analysts who are equity analysts and you're discussing Ghanaian equities, you realize that they are not really focusing on equities in detail. And for you to do equities, you need to be a bit more detail oriented. You need to peel the leaves and really look at the numbers and talk to management. There's a lot of hard work for the kind of rewards you get. And generally, players in Ghana don't want to put together those resources to strengthen their equity teams. So generally, equities research has been substandard. And if you're saying that in your country that you're domiciled, you don't have a handle on research when it comes to equities, then you have, in my opinion, you have no business looking across another market, because that dynamic is completely different. So I've had the chance to look at Nigeria and Kenya for a couple of years. And whilst those markets are exciting, the analysts and the portfolio managers there know exactly what they're doing. So if you're going to just follow the market trend and say that it's exciting over there, let's put money there, you could also lose money, because you will be jumping into a market you probably don't have enough coverage on, you don't have enough personnel looking at the stock, you don't understand the macros, and you are going with a trend on the market. So you may, for a few months or over a short period, make some return because you are following the market. But when things change, for instance, you're talking about currency. We know how the USD GHS works. You know how the GHS Kenyan shilling works. You know how the GHS Nigeria Naira works. All those dynamics come into play when you're looking at other markets. So while I am for the idea that, yes, let's test the waters in trying other geographies when it comes to equities, the bigger problem we face in Ghana is that, and to say it bluntly, we don't have the personnel that will look at other markets. You are probably better off putting it in an exchange traded fund that is managed by somebody in that country that has the expertise in looking at that country. And in that case, you become some form of passive investor if you want that exposure to equities in different geographies, if you ask. Hello?
Seems like Eric is gone.
Yeah.
Eric, are you back? Okay.
Sincere apologies for this. I'm having absolutely terrible connection problem. So sorry to everyone on there, but I'm sure Derrick answered that question in full. The part I caught, I may slightly disagree with you in that we shouldn't have any business looking across, because in my mind, we have 7-year-olds who are asking for iPhone 11 Pro Max. I don't need a research report to tell me that if a 7-year-old is buying an iPhone, 10, I don't even know what model it is, but an iPhone 11, then chances are they will probably continue buying that throughout the rest of their life. So I think some of the research is great, but we buy Samsung phones, we buy Samsung TVs, we buy Samsung air conditioners, we buy various internationally branded goods, but we have no access to these markets. The vehicles that we purchase, we don't have them locally. We buy them internationally. So if we're going to put our money in places where we feel like there's huge growth and we're going to invest in, then I definitely think that we should be open to looking at some of those stocks. And one of them for me that really comes to mind is, and not to pick on the SNIT, but in my mind, if SNIT had even invested in the S&P 500 when it had the chance to, probably about 10, 15, 20 years ago, I think the story will be very different in terms of how we look at how their portfolio has evolved over time. And I think it's a conversation that we should start pushing and having and allowing ourselves to think outside of Ghanaian equities generally. But Derrick, thanks a lot for that. But again, this conference was not just for us, it was for the participants. And I would love to have people ask their questions. Ivy, apologies, but my chat windows, given my screen timed out, has lost all the questions that came through. So I'll be grateful if you can read out the questions and then we can direct them to whoever would answer them. I think the participants have actually asked specifically who they want to answer the questions.
Okay, so let me get what we have here. There's a question from Susie Poplampo to KB. And she's saying, if the general expectation is an upward increase in interest rates because of rising debt positions of the economy, how sustainable can a fund manager's strategy of buying short be when the reverse, that's decreasing rates, is what is happening due to government interventions?
So my point was there's pressure on interest rates to rise, but given the central bank intervention, we think that interest rates may not rise significantly. We may see some few bips upward, but may not rise significantly. And for which reason you would want to play in the 3 to 5 year where you have some yield pickups, because the long end in general haven't provided any rates premium for going long. So you're better off doing or buying into the bonds that have better yields in the 2 to 5 year space. So short, yes, you may do some short, but given the gap between the short end of the market and then the medium section of the curve, I wouldn't be playing on the short side of the curve because it's quite low. You could have 300 to 400 bips differential in the rates.
Can I go on to the next question? Eric?
Yes, please go on to the next question. Yeah.
Okay, so the next question is from Neni Aqua. She says it's a general question to all speakers. I'm assuming it's a female. What is your worst case scenario for the Ghanaian economy, and what are some of the plays you think would help managers survive? To all panelists.
No, thanks for that. I think, and this is why I asked Deborah that question, because I think some of this is not only what happens in the economy overall, but how your fund managers are positioned. And I think she gave a great example of how, you have to be sensitive to your clients' needs, etc. So I think Deborah had it in that answer, but I'm happy for anybody else to add to that.
Eric, I'll just make a quick intervention. Yes, for me, if I were, I had discretionary authority over a portfolio, given, the risk, we are seeing as a result of COVID, I'll be thinking of three, strategies. One, maybe unpack a lot of assets, or pack a lot of assets, into Ghana Euro bond. We are anticipating, because of the widening deficit, etc., maybe the currency might get out of hand going into 2021. So what better place, can we, get, that, hedge whilst racking up some 7%, 8%, yield, than the Ghana Euro bond, which is allowable per our investment guideline. I would look actively again, at equities. Because Derrick, already, mentioned, we are seeing, equities in Ghana trading at an all-time, low. If you look, at the P ratio of most of the counters, on our market. And I believe, with patience, there's a lot of room, upside going, into, 2021 and beyond. However, for us, to see, that rally in equity, I am an advocate, for the regulator, setting a floor on how much equities we can do on our market. We shouldn't be expecting, these foreign guys, to come in and drive market performance when the likes of Tesla and Amazon are giving them extraordinary return. We just have to create our own demand. Thankfully, we have an 18 billion plus pension industry. And I believe if trustees would allocate just about 10% of net asset values to equity, we will see a rally in equity. We have been advocating, for the pension regulator to set a floor. And I believe that is the only way they can relieve fund managers from constantly defending their equity purchase decision. Once there's a floor, you would have no choice than to, stick, to the floor. The problems we have in our market is demand. Equities really, are trading at huge discount. But until there's a demand, we wouldn't see any uptake. So I would do equities, as a risk, mitigant. And perhaps, look at some, gold, ETF, again, having in mind, the dangers of potential FX slippage. If I could, unpack, some assets in the low cost, gold ETF, why not? So those are the three adjustments I would make to my portfolio, given the risk we anticipate, going forward.
And just to, Eric and Ivy, just to retrace the points on equity that Nana mentioned. When Derrick was presenting, he mentioned that earnings to these companies that are listed, for most of them, will slow down. But that is in the short to medium term. And so when you normalize those earnings, just because of this unusual times, you are likely to get some value in these companies. And I like to look at equities in terms of a past ownership in a company as compared to fixing my eyes on a daily change in price. So for instance, if you own shares in, let's say, a fund milk, what will make you sell it? You should have triggers based on the value that you saw to invest in fund milk. And I believe that with time, investors will begin to see the value that you saw to invest in equities for you to be able to make some returns, decent returns in that regard in terms of your portfolio. I do also agree with Nana on the Eurobond, but again, you should be careful about your asset liability matching, because for pension funds in particular, your focus is, you do not have foreign based or USD liabilities to match. And so you must have a very decent and fair view of the depreciation or the performance of the currency in order to make a very good investment decision in that regard. And so those are the points I want to add to Nanette's submission.
You're great. I think, Ivy, there's a few more questions.
Yeah. So this one is from Matthew, and he's saying, how do pension funds adjust for impacts of inflation, forex depreciation on purchasing power following increase in money supply due to the COVID-19 response? Should I repeat?
Yes, sorry, can you just repeat that? You said that quite quickly.
How do pension funds adjust for impacts of inflation, forex depreciation on purchasing power following increase in money supply due to COVID-19 response? So how do pension funds adjust to the impact?
Sure, and KB alluded to this. So even though there is this potential for the markets to widen, because of the interventions that you have, and strangely enough, I mean, we spent some time looking at this, the markets haven't quite widened out because there's still quite a lot of money flowing in the economy. If you think about banks who have had all this sort of reliefs, reserve requirements drop in, all that has created a large pot of money. And because they're not lending to the real sector, all of that money is going into government securities, which is then holding up the prices. So you're not seeing that, and which is why I agree with KB that the market is bound to be range bound for a period of time. even though what the fundamentals will say is that we should be experiencing a widening. So to KB's point, it's a question of timing and which part of the yield curve you stay in, and then opportunistically you manage your portfolio around that. So that's, that's what I think answers that.
Okay, if there's no other comments, I'll move on to the next one. And it's from Selom, and it's to Kwabena Boamah. Which source of pricing do you recommend to fund managers who would want to mark their portfolios to market?
Wow. I think this is a conversation that we need a forum like this to address, and more importantly, GSIA, to look at it critically from an industry perspective. Even though I am for mark to market of our bonds, I would probably not look at bonds that are below 2 years in marking to market. But then again, I will also put it in context. If you have CIS or collective investment schemes that are open-ended, and for which reason people are coming in and going out, and there are no policies on which bonds the portfolio manager can sell at any point in time, then I will probably drop that tenor to less than a year. But anything above a year on such a portfolio should be marked to market to allow for fair values at the point of exit and entry at any point in time. But in terms of pricing, I think on the market now, there's increased activity as far as secondary markets is concerned. So there's pricing available on the market. You have banks giving out their daily quotes on a daily basis. I mean, from Appiah to Stanlib, you have Databank also even coming in with their market offers. So depending on what you agree with your trustees as your source of benchmark or price reference, I think that's what you should use for marking your bonds to market.
The compromise.
But Ivy, just to offer a bit of clarity, I think the question read if you will want to mark to market, but when you read the IFRS now, you do not decide whether you want to or you do not want to. There are specific conditions under which portfolios or holdings should be marked to market. And one of them is at the point of purchase, was it your intention to hold the instrument to collect cash flows in terms of coupons and maturities or and principal, or your intention was to actively trade in that instrument? And that should decide whether you're going to mark that particular portfolio. And here I place emphasis on portfolio, because you cannot decide on one portfolio that you want to mark parts to market and then do the others, other parts as hold to maturity. You can only decide on a particular business model for a particular portfolio. So like KB mentioned, there's a whole education that we need to do on the industry side. And I think another forum will present itself for us to delve a bit more into details on that subject matter.
Yeah, thanks, Deborah. I think that answers Redeemer's question, because he had asked what is preventing the regulators from allowing us to mark to market in the bond market and what will allow it to start. So I think that's a great answer to Redeemer's question. Ivy, any more questions you can see on your side?
Yes. To Derrick and Wiafe, what's your assessment of the impact of the GSE's amended trading rules so far and going forward? Do you think further interventions are needed from other regulators to boost activity on the equity market?
So I will cross Derrick. I mean, I'm thinking, that was pretty much unnecessary if there was demand. The problem with our market is demand. Why should, an Ivy who wants to sell 100 shares of stock move price if there was an Access Pension Trust ready to offer liquidity? What we need is liquidity. And like I said, we've been blessed, to have an 18, plus, billion industry over the last, 10 years. What is preventing trustees from buying equity? What is preventing trustees from buying equity? Do you think, it is for nothing that the US, market, is rallying when average P ratio of the S&P is above, 22%. There is demand. Quantitative easing is driving, demand. So until we leverage, this huge institutional, to develop our market, we aren't going anywhere. Why is it that a whole MTN came onto the market and their IP was unsuccessful? Why then would a Barclays, want to list if they know, if they make an attempt, they won't be successful? So we need to actually leverage, this beautiful, industry, we have to, develop our equities, capital market. It is just 10%, in my view, of total asset, and that is not so risky. Like I said, access is a bit adventurous. So amongst, the many clients, we have, in my view, we have, the largest equity allocation, and that is about 7% of total portfolio. And our first half performance, is in the top, quarter of funds we manage. So equity, hasn't really been a drag. However, if we see a reverse in equity, our performance will be miles ahead of competitors. So to answer the question, that was pretty much unnecessary if we had, liquidity. We had the institutional, guys providing liquidity. That is what happens in every developed market. Retail guys are there. Institutional guys provide liquidity through, their regular portfolio rebalancing. So maybe I'll leave, Derrick, to share his perspective.
I think Nana has been quite candid through this submission. I think I'll be a bit subtle given that my regulator might jump on my neck, but just to add a bit to what Nana said, I feel that what the GSE was trying to achieve with the recent trading rules they introduced was to bring some kind of take away a bit of the noise from the pricing. So for instance, if somebody is trading today 100 CDs, 100 shares of MTN, and somebody traded, let's say, 1 million yesterday, the pricing kind of smoothens out a bit. That was my understanding of what they were trying to implement. What I would say is that they perhaps should have looked at it from maybe a 6 months volume-weighted, value-weighted average approach, where you are looking at the share price over a certain period. So if I traded 100 shares today, and because of my 100 shares, let me make it even CDs so that listeners can understand. If I traded 100 CDs of a particular stock today, and somebody traded, let's say, 2 million CDs yesterday, the pricing should be, we shouldn't just have a volume-weighted end-of-day kind of pricing. We should look at the pricing for maybe 6 months, given that our market is quite illiquid. So we waited over the last maybe 6 months, the last 4 months or so, and that will give us a more accurate picture of what the market is determining price to be. The daily weighted approach, or value weighted on a daily approach, is for a bit more, is for more liquid markets, if you ask me, because at the end of the day, the buying and selling, the demand and the supply will reflect in the price. But for us, the demand and supply takes a longer time to reflect. So perhaps the GSE needs to think about it from expanding the period in which they look at that pricing. So that's just what I'll add to Nana's submission.
Okay, and I this one goes back to you, Derrick, and it's from Elias. You alluded to not buying FML shares because they made losses last year. Is that not too sweeping a statement, since there could be other compelling reasons to buy and take advantage of the falling prices?
I think, Elias, if you remember what I said earlier, I just mentioned Fund Milk and the fact that they made losses. That's why their price to earnings ratio seems so was an outlier. That was why I was explaining it. But what I said in terms of identifying and picking your stocks was more focused on value. So yes, today they made losses, but you are going to have you need to have, let's say, a 3-year, 5-year view the company. So what we tend to do as professional equity managers are that we build our models. We discuss with management what the 3-year medium-term plan is, what the markets are doing, and we compare our estimates with what has really come out. And our earlier discussions with Fund Milk, and given that Fund Milk is a public company, I think we will be able to divulge that information on this platform, was that there's a lot of impact of COVID-19 on their sales line. So that was why they ended up reporting the figures they reported. I feel that going forward, when you are taking a view on Fund Milk, you need to look at it not just from today, but look at it from maybe a 3-year, 5-year out, and then do your valuations and find out, does this make sense? Is it a good time for me to jump into Fund Milk or into any other stock? And that's how equity investment should be looked at. You just don't look at it and say that, oh, it's dropped 30% in price, it must be cheap. It may have dropped because they are going to revoke their license. So you need to peel away a bit more to be able to understand the fundamentals in order to invest.
Okay, it looks like the equity market is on fire today. Another question to you again, Derrick. Aside all the fundamental analysis that can go into an equity research, how do we make a strong case for equity investing in a high interest rate environment and in a market where our macros continue to deteriorate? That
is a very good question. I tend to tell my fixed income team that they're always on my neck saying, well, I don't know why, Derrick, you're bothering, because fixed income is literally what's paying you, because equities is not doing much. And my response often is mark to market and let's compare. Take away the coupon payments, which is a strong part of the argument. I will also put in my dividend income and we'll see. But let's look at it from a capital appreciation point of view. And you realize that over the last 3 years, it hasn't, in terms of capital appreciation, when you mark to market, and we use I think the S&P Ghana government bond for that exercise. And you realize the difference isn't that much. In fact, when you go all the way to the parts where the GSE was returning 52 and 73%, and you are looking at it from that point of view, you realize that in certain times, the equity market even beats the fixed income market. So for me, I'll say that they are two good cases. Both fixed income and equities are good, but your timing needs to be critical. Now, coming back to Elias's question, I think that the high interest rates affects trustees and generally local investors' view of investing in equities. For instance, if I'm going to buy just a 2-year paper and I'm going to earn maybe 20% or 19%, and I'm going to lock in for 2 years, that is guaranteed. So I agree that if our regulators and the policymakers want equity markets to thrive, which is a long-term growth driver for the economy, they need to really look at the interest rates. And if you go to Nigeria, look across to Nigeria just overnight dropped their rates because they are telling you that COVID-19, you can't keep expecting government to finance or provide you the return. I've dropped below inflation. Go and look for your yields. I'm not saying we should go for a swooping statement like that or a swooping policy like that, but if we indeed want to make equities and thinking about pension being a long-term growth driver of the economy, we need to start looking at interest rates and seeing where it makes sense. Because as KB was saying, 90% or 70% or so of pension is in that sector. If Bank of Ghana came and said that, okay, our new issuances, we are guiding at a coupon of maybe 15% or 13%. All of a sudden, KB will start looking for other places to generate alpha. So I think policymakers must look at rates, especially on the fixed income side, to be able to drive long-term growth. And as a result, I feel the equities market will also be dragged along that upside. Thanks.
Okay, the next question is from Randy. This sounds like an internal IC conversation. Given that the market has been quite irresponsive to information, especially on earnings, What do you think are the key catalysts to bring convergence, and what are the timelines?
Timelines is difficult to say for equities, and that's why it makes equities a bit challenging for a lot of investors, especially for Ghanaians, because let me take the first part of the question. There's a divergence between market response and also what we are seeing in terms of earnings. To just correct the question, half-year results were surprisingly stronger than we estimated. We were thinking at the height of COVID and all of that, we are going to see a lot less lower earnings than what we saw. So it was good. Market hasn't responded to that. And we think that it's mainly because we are in a panic period where nobody's even looking at that asset class. So we don't really care, or we don't even see some of the good earnings coming through. Everybody gets their allocation or their contribution, and they are thinking about fixed income or where can I keep it safe, which is all well and good. So we are missing out on these things. I think that if the market is going to react, or market is going to look at equities as an asset class again, a lot of the noise coming through from COVID-19 and the uncertainties need to subside quite a bit. And then investors will come around the table and start looking at the numbers again. But the good side is that I feel that equities has taken a lot of the beating, way too much beating than even their macros. So whilst I am of the opinion that we are going to see a similar kind of whooping when it comes to fixed income next year, when the currency starts behaving in another way, given what we are seeing in the numbers, equities might not see that level of beating. We might not see a bull market, but we've taken a lot of the hit over the last few years that if we take any further beating, I just don't see that much further beating going ahead, because I think all of that has been priced into equities already. On timing, it's difficult to say when we are going to see an upside, but I feel once the noise subsides and we start looking at fundamentals again, investors will start coming back into equities. For investors who are listening in, it might be too late. So I would say that look at the valuations and take a position now and just be patient.
Okay. So we are well past the time we're supposed to end. I'll take one last question and then we'll wrap up. The rest of the questions, I'll send it over to the panelists so that you can address them directly to those who sent them. We will have their email sent to you as well. So the last question is to KB. On the fixed income space, would you support an increase in the allowable limits for government? The person says Gavis, so I guess that's government. A school of thought believes such a move would crowd out the private sector.
Yes, Ivy. I would believe so. Already we've had trustees write to the authority asking for permission to breach, and that is because it's been capped at 60%. In the new guidelines, there's a proposal to move that limit to 75. But you're right. I mean, the questioner is right that if you have a situation where Government of Ghana securities is open full 100%, we will have no interest in other investment asset classes. And like equities, what Derrick was saying, there are some opportunities in there. But if you don't provide that incentive or that restriction to allow portfolio managers and trustees to look beyond Government of Ghana securities, they will sit comfortably in the Government of Ghana securities space. So yes, I'll agree that there should be a restriction so that portfolio managers and trustees are forced to look beyond Government of Ghana securities.
Thank you very much, KB. So I guess this brings us to the end of today's event. Very good turnout. The questions, I have like 20 more questions that you need to answer. So I'll be sending them over to the panelists to address them. So we have all seen the effect of the challenges we've had over the past few months from COVID-19. A lot of impact on our economy. We've seen the numbers in bright colors. But I've also seen that there are lots of opportunities that we can take advantage of. And if you are well informed, which I hope this event has given you some information to work with, and you are skillful, if not, you can contact any of the panelists to help you out. They are experts in their field. And if you are liquid, you can take advantage of all the opportunities that we've talked about today across the investment universe that we have in our country without even stepping out of Ghana. We've had our experts to give us the information we need to start exploring these opportunities. So on this note, I'd like to say a big thank you to all our panelists for sacrificing the time to inform us about these opportunities and the risks that we face and how to take advantage of them. And I'd also like to say a big thank you to Axis Pensions Trust for supporting the CFA Society Ghana to organize this event. And to all you distinguished panelists, I say a big thank you for showing up to make this event a success. Without you, we'll be talking to ourselves. So thank you very much for showing up and staying till the end. We've had a very good turnout, much better than we expected. And lastly, but not the least, we say a big thank you to God for a successful event. We called him in the beginning and he stayed with us till the end. And you all agree with me that it's been a successful event. We hope you all have had an enjoyable event with us. And more importantly, you will show up again for the next webinar or other event that we invite you to support the CFA Society Ghana as we ramp up efforts to help build a resilient investment, pension, and financial sector industry in Ghana. Thank you everyone again, and bye for now.